Welcome to CNN Vantage Point. I'm Craig Morgenstern, Senior Investment Officer with CNN Wealth Management, and today's podcast will provide a market review for the month of October 2025 and our current outlook. Global economic momentum continued during the month, but showed clearer signs of cooling. U.S. economic growth proved resilient, with U.S. GDP near 3.8%, though hiring slowed and unemployment edged higher, signaling a softer labor market. Inflation continued to ease gradually as core PCE hovered near 2.9%, but remained above the Federal Reserve's target. This dynamic leaves policymakers to balance between cooling price pressures and slowing employment gains. Overall, the Fed faces a delicate task, sustaining progress on inflation while protecting the economy from tipping into a slowdown. Financial markets remained upbeat, though, throughout the month. U.S. equities hit fresh highs, led by technology and AI-related stocks, as investors grew confident in the likelihood of rate cuts ahead. Bond yields eased, with the 10-year Treasury near 4% and a modestly flatter yield curve, while corporate and high-yield debt posted gains. Commodities diverged. Gold rallied to record levels above $4,300 an ounce on real asset demand, while oil prices weakened amid excess supply and slowing global consumption. Real estate markets were supported by lower yields, though underlying economic softness tempered optimism. Global investor sentiment remains cautious amid rising geopolitical and financial risks. The IMF warned of potential disorderly market corrections driven by high valuations, growing fiscal deficits, and renewed trade frictions. U.S.-China tensions resurfaced and then subsided, while instability in the Middle East kept energy markets on edge. These cross-currents, combined with stretched U.S. equity valuations and a fragile bond backdrop, underscored the narrowing margin of error in global markets. Investors remain focused on fiscal policy and tariff negotiations in Washington, both of which continue to influence market sentiment. Although recent corporate earnings reports have generally exceeded expectations, many companies are issuing cautious forward guidance. The Federal Reserve's policy decisions play a key role in shaping market direction, as persistent inflation and mixed labor market data complicate the path forward for monetary policy and economic growth. We will rebalance and reallocate portfolios in the coming weeks. Our approach to portfolio construction emphasizes diversification across and within asset classes. We maintain a neutral stance on equities, with a slight value tilt, and remain structurally overweight U.S. equities relative to international and emerging markets. Fixed income serves as a ballast from portfolio volatility, particularly as yield curves normalize and credit spreads remain narrow. Given tailwinds from Federal Reserve rate cuts and balance sheet activities, we will reduce core intermediate-term bonds to take advantage of opportunities in high-yield bonds and real estate equities. We retain a neutral view on TIPS as inflation and tariff concerns persist, and favor real estate due to its attractive valuation and recovery potential. We'd like to remind our listeners that market conditions can change quickly. As circumstances and facts change, CNN's market views and portfolio positioning may change accordingly. If you would like more information about our current positioning and market thoughts, please contact any of our wealth management advisors. And if you like this podcast, we'd be grateful if you would share it with your friends. On behalf of the entire CNN Wealth Management team, we thank you for listening.
Please note, views are subject to change based on market conditions and other factors. These views should not be construed as recommendation for any specific security or sector. Client portfolios may or may not be at the positionings discussed due to, but not limited to, distributions, tax management limitations, systematic purchases, etc. Some products are not FDIC insured or guaranteed, not a deposit or other obligation of the bank, not guaranteed by the bank, and are subject to investment risk, including the possible loss of principal amount invested, and are not insured by any other federal government agency.